Hello my friends. So today I would like to explain to you how does your tax return work, like when you are going to file your taxes, what happens. So I will explain to you in a very simple format. In any personal tax return, generally speaking, there are three parts to it. Number one, you have income. Number two, you have deductions. Number three, you have credits. That's it. There's nothing else. It's very simple. So we are not going into details for each item, income or deductions or credits. I am just trying to explain the concept. What is the concept of tax filing? How does it work? Okay. So you have income from different sources. You can have a W-2, you can have stock transactions, Robinhood, Webull, 3D Ameritrade. Last couple of years, everybody seems to have a Robinhood account. Then, you might have unemployment. You can have a business. You could be self-employed, Uber driver, delivery guy, anything. So you have income from different sources. Now, how much tax you are supposed to pay on that income? Then after your income come deductions. What are the deductions? Deductions are amounts that you can deduct from your income, not from your taxes. You have income, then you take deductions from your income, such as if you're filing as single, if you're filing as married, filing jointly, if you're filing as head of household. So the government gives you a standard deduction, or you can have itemized deductions if you have a house and you pay mortgage and you have a property tax and you have medical expenses, but we want to keep it simple. So you have either standard deduction that government allows you to take, or you can have itemized deductions. So the main purpose of your deductions is to reduce the amount of income that you have. So this way your taxable income, the amount that you have to pay tax on, is reduced. So let's say you make $50,000 and you're filing as married. So the government gives you, I think, about $25,000 and change as a standard deduction. The balance, $25,000, you are supposed to pay tax on. So income, deductions, you are left with taxable income, the amount that you have to pay tax on. I know I'm repeating myself. I am just trying to drive home the point, the concept. So now we have taxable income. Now come credits. The credits are the amounts that help reduce your tax liability. So what is tax liability? Basically, it is the amount of tax that you have to pay. So let's say for this example, you owe IRS like $4,000. Income, deductions, taxable income, and based on that taxable income, you owe, for example, $4,000 tax. So now, if you have children, you will get child tax credit. If you have, let's say, solar panels, or you bought electric vehicle, or you had energy efficient appliances in your home, all these things might add up to reduce the amount of tax you have to pay. Then if you had W-2 and you already paid some money to the IRS through your payroll, that also will reduce the amount of tax you need to pay when you're filing the tax. So guys, that's what it is. In a simple format, you have income that you're supposed to pay tax on, but the government gives you deductions that reduce your income that you have to pay tax on. Then you have credits. So some credits are refundable, some are non-refundable. It means non-refundable credits are those that only go to the limit where you have to pay the money. Let's say you owe government $4,000, but your credits are $4,500. So your credits are more, $500 more. But if those credits are non-refundable, you will only get credit for $4,000 because that's what you owe. But refundable credits, such as earned income tax credit that you get for very low income if you're single, or low income and you have children, qualifying children, if you owe $4,000 and the total credits are, let's say, $6,000, you will get $2,000 back in the form of refund because that credit was a refundable credit. So I hope it helps. Thank you very much.